Hello and welcome to this brand new episode of Smart Money. This is our year-end special where we look ahead to 2023 and talk about the top themes and stocks to invest into in the year to come. Our guest today is Trideep Bhattacharya, who is the CIO-Equities at Edelweiss AMC. Trideep has over 15 years of experience in the business of fund management and manages the Edelweiss Mid-Cap Fund. He'll talk about the big themes that you can watch out for in 2023. Trideep, thanks a lot for joining in. At the onset, I just want to check with you what your view is on the market overall. Is this a year where you think India could perhaps underperform, considering all the global challenges that we've seen upon us?
Good afternoon, Sonia. And I would say that overall, my view from a medium-term standpoint with regards to equity markets is constructive. I think given that particularly the last 6 months have been quite buoyant, there could be a period of volatility, particularly in the next 3 to 6 months, the first half of calendar 23. But I think from a 2 to 3 year perspective, there are some strong underlying economic themes which are playing out on a bottom-up basis in India, which makes me quite constructive on India's earnings estimate, India's story, and India relative to the globe as well.
Okay, so let's talk about all these themes one by one, right? You've come up with 5 top themes to invest into in 2023 and perhaps something that our viewers can look at as well. Let's start. What is the first theme that you're looking at?
I think the first thing that that I would like to talk about is basically the CapEx theme overall. And I think somewhere around December last year, January this year, we did an insightful analysis as to summing together the CapEx plan of all the listed companies. And for the first time, what we saw that the combined CapEx announcements made by private sector companies turned out to be 6 to 7 times that of public sector CapEx announcement. This was the first time that we saw such a phenomenon happening in the last 10 years. And mind you, these are CapEx plans to be executed over the next 3-4 years. So this is from a medium-term standpoint, a positive. We are somewhere towards 9 to 12 months down the line from that starting point. And I would say the product has been, the progress has been fairly robust in that count. The capacity utilization in the country has marked towards about 75% odd levels from where CapEx levels usually start. And secondly, multiple sectors have actually joined the bandwagon more than what we started for. So the theme has become stronger. And I would actually pontificate this as one of the strong themes, not just for 2023, but even from the next 2 to 3 year perspective from an Indian context.
Okay, so that's the first theme for 2023 that Edelweiss is very bullish on, which is the private sector investment demand or the CAPEX theme, and they're overweight on industrials, capital goods and construction. Now, of course, we do know that some of the companies here, the likes of Cummins, ABB, Siemens, etc., have done very well in 2022 too. Trideep, that was my follow-up question to you. Many of these companies, the market leaders in this space, whether it's Cummins, whether it's L&T, they've started to perform this year, right, in 2022. So do you think that this is there's still some more headroom for growth, both in terms of valuation as well as earnings potential?
I would actually say that 2023, particularly towards the second half, would see an improvement in earnings estimates of these companies to start playing out. So yes, the stocks have rallied in anticipation of earnings upgrades, but I think that will probably come through towards the back half of 2023 as some of the projects that they have undertaken in second half of 2022 get through the execution time frame, and that's when the stocks on the face of it, on the back of higher earnings estimate, may not look that expensive, but then overall from a growth standpoint will look fairly robust. So to answer your question, yes, the valuation expansion has happened. The earnings expansion lies in front of us over the next couple of years, particularly in second half of FY23.
Okay, so the theme number 1 that you're looking at is the CAPEX theme. Theme number 2, let's move on to that. You're looking at a big rebound in credit growth, because if there are CAPEX plans, then somebody needs to fund it, right? So you're bullish on financials?
That's a nice way to put it. I would put this in a bit of a context that overall, if you look at the Indian financial services sector, particularly the subsector which is lending financials, over the last 3 to 4 years, they have seen a bad asset cycle play out. Most of the books or the books of most of the companies, whether even the PSUs as well as private sector banks, are reasonably clean. That's a good starting point. Second, overall, the Indian corporate sector over the last 3, 4, 5 years have nicely deleveraged to a level where they are surplus with cash flows. So overall, they are looking to invest, and with regards to whether it is working capital or brownfield projects, they are looking out to get a bit of funding in. And that is why we have seen, particularly towards the back half of fiscal 23, which is the current year, some pickup in credit growth, and we would surmise that we would see more of it as the year progresses, particularly in calendar year 23. And hence, we feel that the lending part of financials as the earlier part of economic recovery would stand to benefit from the same. And hence, we are overweight lending financials across our portfolios.
Okay, overweight lending financials, and I was going through your mid-cap fund that you manage, and within that, some of the stocks that you have in the financial space are Federal Bank, there's City Union Bank, there's Cholamandalam Investment, there's Credit Access Grameen as well. Now, what do you do at a time when there are some issues that come up? Say, for City Union Bank, there is this recent issue as well. There could be some hit to their loan growth that we've seen. So when there are these minor roadblocks for companies, do you ignore it, or do you use these as a dip? Or do you use the dip as a buying opportunity?
A great question. I would say, to answer your question in one shot, to use them as buying opportunity in dips. But let me elaborate. Financials is a very macro-linked sector overall. And somewhere around the line, there could always be a bit of a hiccup, whether it's an opinion with regards to NPAs or any such measure, so to speak, because the regulator is deeply involved in the same. And hence, off and on, you do get opportunities where you can participate in, particularly in MSME lending overall, or SME lending, or MFI lending in a cleaner way, particularly when it comes to financials, which are actually seeing a good bit of growth as far as credit offtake is concerned. So on the whole, if you look at the segment credit growth, we have migrated from a 6 to 7% growth sometimes last year to close to about 16 to 17% credit growth as we speak. And we have probably settled around 13 to 14% credit growth sometime next year. And all of the sector, particularly the lending financials, would be a beneficiary of the same, as some of the names that you mentioned clearly fall in the same sector.
Okay. In fact, on City Union Bank, just wanted to apprise our viewers that the RBI had found a divergence to the tune of almost 260 crores in the NPA provisioning of City Union Bank, and hence that stock was under a bit of pressure. That's why I was asking whether, when these issues come up, how do you sort of approach it from a long-term investor standpoint? All right, got that. So financials is your second theme. Let's move on to the third theme, which is household capex demand. Tell us a little bit about that. Is it purely restricted to the real estate companies, or do you look at, the tile makers, the sanitary ware companies? What is it in household capex that attracts your interest?
Yep. To explain this, let me kind of put a bit of context around this. As we studied the situation with regards to Indian real estate market, both in tier 1, tier 2, tier 3, all put together, what we found is that the unsold inventory had reached 10-year low. Generally, when such a situation happens, the sector bottoms out from a long-term perspective. Usually, real estate is somewhere around 5 to 7 year cycle. And I would surmise that we are probably somewhere in the first 2 to 3 years of the same, where the unsold inventory is bottoming out, following which you might see some better launches coming about, maybe higher prices, and then kind of, the other side of the cycle overall. But net-net, in the context of 5 to 7 year cycle, we are probably somewhere in the first 2 to 3 years. Now, while this is the phenomenon that is happening, how do we play this? One way to play is basically to own the builders. The second way to play this is to buy the ancillary providers to these companies. And I have historically found in my career that generally buying the ancillary companies or companies like building materials, etc., who supply to real estate as a sector are a better way to play this, because they are better margins, better return ratios, and occasionally they have better moats as compared to many other companies. So all in all, to play this uptick in real estate cycle, you'll probably be more overweight the allied sectors than the real estate sector put directly. But on net balance, from a next medium-term standpoint, we do see this as a genuine positive bottom-up themes, very specific to India, playing out over time.
Okay, in fact, I do notice in your fund, in your mid-cap fund, you've covered the entire gamut, right? I mean, you have a real estate player like Brigade Enterprises, you have the ceramic supplier like Kajaria Ceramics, and you have a cement supplier like JK Lakshmi Cement. So perhaps this is a great way to play the household capex demand as per Edelweiss. Don't just pick the real estate guys, but also look at some of the ancillary guys who supply to real estate makers. And those are where the real alpha lies, particularly because of the kind of appreciation we've already seen in some of these real estate stocks. But let's do one thing. There's 3 themes that we've already spoken about, but there are 2 more to go. In case you missed them, the top 3 themes that Edelweiss is bullish on, there's the capex theme, there's financials, as well as the home improvement theme. But there are 2 more themes to go. So do stay tuned in. We'll slip into a short break and be back. Welcome back. You're still watching Smart Money on CNBC-TV18. We're talking about the big investment themes that you can look at in 2023. We're done with 3 themes, and now let's move forward. Trideep Bhattacharya, the CIO-Equities at Edelweiss AMC, is our guest. Trideep, the next theme is global market share gainers. And this is very interesting because there's now, I mean, not just China +1, but Europe +1 as well. And a lot of Indian companies are big beneficiaries of that. India has sort of become the global export hub in the sense across many industries. So tell us about the big beneficiaries of this theme.
I think, as you rightly said, the context over the last couple of years, given the geopolitical situation as it turned out to be with regards to China-US relations and also Russia-Ukraine war, I think what the global outsourcers have generally coming to a view that we, apart from just the lowest cost producer, we do need reliability of supply, particularly when macro conditions turn a little volatile, stroke hostile. And in that context, keeping scale in mind, India emerges as one of the alternatives, particularly to high outsourcing destinations like that of China. And certain subsegments like chemicals, etc., IT services, anyways, form an incredible alternative to Chinese suppliers, because we do have suppliers that can supply the same sort of products from here. May not be as competitive as that of China, but overall, from a growth standpoint or from a value-add standpoint, equally keen and equally capable. Keeping this in mind, what used to be China +1 about 2 to 3 years ago has now become Europe +1 as a theme. Now, there is a bit of a difference between the two. While China +1 is a good top-line opportunity, Europe +1 could be a strong margin opportunity for Indian players as well, because clearly the cost takeout once a manufacturer relocates from Europe to India is quite significant. And hence, in that context, what turned out to be a top-line opportunity to start with in the form of China +1, including Europe, now becomes basically a revenue as well as a good margin opportunity. So we overweight this particular theme in our portfolio, and we think that this could be a strong area to go for, particularly after having seen some of the worst cyclical days in the globe as we head into 2023, and some parts of Europe and US recover. You could see some buoyancy coming about in these sectors as well. So it is also a play on cyclical global recovery. Also, if the fact that structurally market share moving from China towards India could be a strong profitable opportunity as well.
Oh, absolutely. And also now with the whole COVID situation blowing up in China once again, there will once again be more opportunities, unfortunately, more opportunities for markets like India. I say unfortunate because nobody wants this kind of COVID situation, right, across China. I mean, it's been
Absolutely.
the worst that China has seen throughout the pandemic. But does that also put at risk some of these companies that get their raw materials from China? Because I was going through your list. The beneficiaries of the China-Europe +1 demand are, names like PI Industries, Tata Chemicals, JB Chemicals. These are stocks that you have in your mid-cap fund. So I ask you, is there any risk to their growth because of perhaps a supply constraint in China, because of what's happening there?
I think well spotted. I would say that for better part of 2022, they faced the supply challenges, and that impacted their margins overall. If you look at particularly in the first half of fiscal 2023, which is why I said as we get into calendar 23, which is the next year, and some of these supply challenges ease as much as they had gone up in the past, actually more so driven not just by the Chinese condition, but also Russia-Ukraine war. They can get a bit of a stability from a margin standpoint, and if the top line continues to be buoyant, you have a strong top line as well as earnings growth opportunity. But yes, given that some of the inputs that these companies use are global commodities, they are at risk usually with regards to to those times when commodity prices go up. My only point is that given where we have seen commodity prices in the light of supply chain challenges, particularly in the first half of 2022, the year that lies ahead hopefully would be better than what we were before, and hence better times for these companies.
Okay, so that's the fourth theme, the global market share gainers. Let's move on to the fifth theme now, which is beneficiaries of the government growth schemes. Now, this is interesting because the only sector that really stood out this year in that sense, which was a big beneficiary of government growth schemes, was defense. And some of these stocks feature on your list as well. My question to you is it a sector that is juiced out completely, or do you think that there could be more to go?
I think these, basically, if I were to sum this up in the form of domestic, purely idiosyncratic themes which are only applicable to India, makes the India story relatively unique in comparison with some of the other countries or emerging markets that you deal with. And in that, indigenization of defense is a strong theme, as much as a PLI beneficiary being the other one. These are the two that I would name. And these are very unique to India in the way it is going about. You talked about defense. So let me say that while the India defense opportunity is looking to grow at about 20% as a headline opportunity over the next 10 years, that's what the government plan is. On top of that, the indigenization would lead to superior growth as well, on top of the macro opportunity. But if you look at some of the valuations of the stocks that are trading today in India, they are trading at similar valuations as some of the global defense manufacturers. So this is one pocket, maybe because of the PSU nature of it. But overall, while the growth rates would continue to be strong and they will have strong tailwinds, the valuations yet are not maxed out. And hence we see, along with earnings growth, stability in valuations as one of the factors that will play out in this company's favor over the medium term, 2023 being a good starting point with regards to the same.
Okay. Now, you know what? The common question that I get asked by a lot of viewers is that if one wants to capture all these big themes through the mutual fund route and an investor has no time to individually research stocks, what are the funds that I can look at? Now, you've consolidated 5 themes for us. You manage the mid-cap fund. Does that have, you know, sort of a cocktail of these stocks in it? And if you can just tell us, what is the average return that one can look at, say, over the next 3 to 5 years?
That will be putting myself on a tough spot. But I would say that investors today have a wide range of choices, amongst which one of the things that I feel strongly and passionate about is obviously the fund that I run. And the areas that we discussed are the areas that we are overweight in, particularly in the Edelweiss Mid-Cap Fund. I would just put the credentials in front of the investors and they can judge for themselves. I would say that overall, the fund size is still at a level where we can get reasonable size positions with regards to the stocks that we want to own without hampering liquidity. Second, this fund has almost a 15-year track record, makes it one of the longest mid-cap funds which are there or thereabouts in the horizon. And third, the themes that we talked about are adequately represented in this fund in a meaningful way. So those would be the 3 things that I would like to kind of talk about in the context of the Edelweiss Mid-Cap Fund. If that catches interest, I leave that to the investor to make the better decision.
Okay, in fact, I think we have a plate on what the Edelweiss Mid-Cap Fund has done in terms of returns over the last 3 years, over the last 5 years as well. Here you have it. This is the size of the fund. It's almost 2,500 crores. A 3-year return of the Edelweiss Mid-Cap Fund has been about 26%, while a 5-year return has been 13.3%. So if you are looking to get better returns, it's not just this fund, but investing in any mid-cap fund will perhaps give you more aggressive. The risk is higher, but the returns are higher as well. Trideep, just to wrap up, in the last 10 years, the investment strategy has changed drastically. Earlier it was just hold and forget, but now there are trends that are emerging and getting over in a span of months. What can you expect in the next 1 year?
I would actually say it's a great question to sum it up. And I would say something like this. Over the last 10 years, we have been dealing with a situation where interest rates have been falling, inflation has been falling, and we have been dealing with a globally synchronized capitalistic world. Over the next 10 years, we will have to deal with probably a situation where interest rate might be rising on the back of the fact that inflation might be a little more sticky than what earlier the case used to be. In such circumstances, the investment style that works might actually be a little different from what it used to work over the last 10 years. For instance, what I'm talking about may be that, while we were used to PE re-rating as a common theme over the last 3-5 years, maybe going forward, earnings growth will have to take precedence, and overall PE, we have to contend with a little bit of PE derating in the process of making the investor returns over a period of next 2 to 3 years. That's one. Second, I would say that country-specific dynamics become a lot more important rather than synchronous movements like what we have been seeing over the last 3-5 years in equity markets globally. I think this is where some of the themes that we talked about, which are very specific to India, comes to center stage and will hold out true for India overall.
Sure.
So given all this in mind, the bottom of stock picking is the way to go about it. Earnings growth is the way to sort of, plant your bets. With that, those would be some of the changes that I would suspect would come about in investment style. And, there you go.
Well, thanks a lot, Trideep, for that. And thanks for kickstarting 2023 with a bang with all the big investment ideas to watch out for. But as always, we don't end the show without a financial tip of the week. And this time it's on mutual funds. Now, do you know what is a direct plan? One may invest in mutual funds directly, that is without involving or routing the investment through any distributor or agent in what is called a direct plan. Or you may choose to invest in a mutual fund with the help of a mutual fund distributor or agent, and that's called a regular plan. Now, direct plans and regular plans are both parts of the same mutual fund scheme. They have the same common portfolio and are managed by the same fund manager, but they have different expense ratios, which is basically recurring expenses that is incurred by the mutual fund scheme. So a direct plan has lower expense ratios than the regular plan, and there's no distributor or agent involved. Hence, there is savings in terms of distribution costs, commissions paid out to the distributor and the agent, which is then added back to the returns of the scheme. Hence, a direct plan has a separate NAV which is higher than the regular plan's NAV. In due course, the lower expense ratio of direct plans translates into higher return on investments, which keeps compounding over the year. Thus, the investment in direct plan would be worth more over a period in comparison to investing in regular plans of the same scheme. Well, with that, it's curtains down on this edition of Smart Money. Thanks a lot for watching.